What does your portfolio look like right now? I know you were kind of all Bitcoin, then you went Bitcoin and Ether. What does that look like today? So we just understand the perspective you're coming from.
My current allocation is probably 70% ETH, 5% Bitcoin, and then a tail of others. So why that allocation? It's nothing against Bitcoin. It's not against anything else. It's because I'm a financial markets guy and we use risk curves. So at certain points in the cycle, in the middle of a bull market, you want to take as much risk as possible. So you want to go to the more speculative end of the market. So firstly, I isolated the fact that I thought Ethereum was going to see further flows. It's early in its adoption cycle, and that will probably drive prices further than Bitcoin, and that seems to be playing out. With the others, there's so much going on, it's difficult to monitor. So I have kind of basically a relatively broad-based portfolio to capture some of that move when the tail goes up, i.e. the furthest risk out. And that happens in credit markets, equity markets, all over the place. In equity markets, in a bull market, you tend to get the big leaders first, which is where the safe money is, the blue chips. Then eventually people move to emerging markets, and then they move to frontier markets. And it's in order to get more bang for your buck in the middle of the cycle and generate some alpha. So it's not a comment per se on my relative view on the success of protocols or something like Bitcoin. It's nothing to do with that. It's about how do I make money out of this crypto investment whilst maintaining my level of interest in the overall crypto world. And so that's where I am now. Where would it be in a year's time? Maybe it's much more Bitcoin again. So it's an asset allocation strategy to try and enhance rewards.
Now with inflation on the CPI basis being up over 5%, pretty much every bond that is held by pension plans, endowments, foundations, etc., is negative yielding on a real return basis. How does that play out kind of across the financial markets? And then obviously for some of these organizations that, whether it's for salary or for retirement purposes, people are really counting on?
So it depends whether you think inflation in that CPI measure, not this debasement measure, the CPI measure stays over 5%. I don't. I think it's absolutely structurally impossible because of demographics, debt, globalization, and technology. So I don't think that's possible. But we've also seen that in Europe and Japan, the institutional sector has been happily buying negative yielding bonds for, best part of a decade now. So that bonds continue, but that again is just locking in some sort of relative level of poverty. So you owning bonds and your pension plan owning bonds is really making you worse off over time. I mean, bonds can be a trade, and that's fine. And I think bonds probably rally for the next 9 months, but overall, you're still not going to make enough money out of that to paper over the cracks in how much money is being kind of stolen from you via inflation at the time being, and then debasement, which I think is the bigger structural problem.
When you think about us now in a bull market, makes sense why you're allocated the way you are. Will you then look to kind of consolidate into the large caps in a bear market if you think that's where we're headed? Or do you, how do you think about the transition?
I'm trying to get my head around this, and I'm thinking that, yes, I will move down the risk curve back to the safer assets, where I think there's less volatility. You can use, some yield from stable coins or staking or whatever to lower your volatility. And then you want to be looking to buy the speculative end of the market that's going to get destroyed, whether it's parts of the NFT space or parts of the kind of general token space that gets destroyed in the next bear market, to buy those when they're heavily discounted, but they still have network adoption effects or some perceived value or cash flow. That becomes really interesting, because then you can start allocating in the middle of a bear market into the riskier assets to buy them super cheap. And that's typical of credit markets and equity markets. People always do the same, and that's where you get the alpha from, is getting this asset allocation right. And very few people do it because they're still a little bit blinkered to one project. And the idea is you can believe the whole space goes up. You can even have total belief in one project, but it's a long time to get there. So is your allocation weighted correctly for you to reduce the volatility a bit so you can sleep at night in the bad times and get a bit of extra outperformance in the good times?